The content of this video is for educational and informational purposes only. It does not constitute investment advice or a recommendation to buy. All analyses, models, and strategies represent personal opinions. No guarantee of accuracy or completeness is given. The full disclaimer can be found at the end of this video and in the video description.
Welcome to a premiere on Learn for Finance. Today, our new podcast format starts. We show how you can achieve surprising returns with seasonal stock strategies. And of course, I am not alone. Here is Lisa.
Hi everyone. Today I will ask all the questions you might also be asking yourself. No excuses. Axel has to deliver. Ready?
Am I ready? Never been more excited. Today we're diving deep. 3 stocks, 10 key figures, one of them with almost 93% hit rate. But don't let the hit rate impress you. And don't worry, Lisa, you can ask me anything.
Wow, that sounds like a real in-depth analysis. But before we get lost in the numbers, what exactly is this seasonal strategy?
Very important. A note for all newcomers. Be sure to watch the introductory video linked above. We explain in detail how seasonality works in the stock market and why this topic and the seasonal stock portfolio are so exciting for you. This will be our new regular podcast. We are starting today directly with the current favorites. Still, Lisa, I am happy to briefly answer your question for everyone who is new. What is seasonality? Very simple. We use data analysis to look for recurring patterns. Just as ice cream sales are better in summer, there are stocks that perform statistically better in certain months. And today, we are examining these patterns in detail, with data dating back to 2007 or 2008.
It was clear that you would bring up the ice cream example again, you rascal. I love ice cream.
Of course, I didn't know that. But today it's not about ice cream, but about the hottest stocks for the summer. Let's start with Candidate 1. Candidate 1. The silent champion from the healthcare sector, ResMed Inc. The seasonality at ResMed starts on June 27th and ends on August 1. This is the investment period. Makes sense. If one of these specified days is a public holiday or weekend, you buy and sell accordingly on the next possible day. ResMed is the world market leader for devices against sleep apnea. Their strength, market leadership, and a digital ecosystem that binds doctors and patients.
Sounds solid. Where do you see the biggest growth?
Clear, the dark figure. Over 80% of sleep apnea cases worldwide are still undetected. Huge potential.
And the risk?
Dependence on the core market. New treatment methods or regulations would be dangerous. Dependence on sleep apnea does not have to be bad. But if things stop working there, ResMed has a problem. When we look at the threats, there are clearly 3 areas worth mentioning. First, competition from new technologies. Second, regulatory hurdles. Third, cybersecurity risks. So Lisa, now I'll briefly take over your part. Some viewers might now be asking themselves, why does Axel talk so much about the company? It doesn't really matter. It's just seasonal. Bingo. Theoretically, yes. But I think it's important to learn something fundamental about a company. If the fundamental story of a company is shaky, then the statistics are also shaky. Because we check the statistical history, but invest in the future. Like yin and yang.
Axel, I couldn't have said it better.
But the main reason ResMed is on our list today is the seasonal data.
Now comes the proof, the numbers.
The last 15 years, success rate 86.67%. 13 positive, 2 negative years. But success rates are no guarantee for the future.
13.2, awesome. And the performance?
Average plus 6.1%, best year plus 15.5%, largest loss 4%.
Minus 4% as worst case, that's still acceptable. Was the trip calm?
Very. Volatility 5.93%. Drawdown max 4%. Historically a rock, but the future remains open.
And the risk indicators?
Sharp ratio 1.03, Kalmar ratio 1.53. For the risk, absolute top.
Wow, impressive performance. ResMed is the best in its class. Now your sports star is coming, right?
Exact. The superstar, Apple income seasonal period from June 29th to September 2. So a period of almost 2 months during which one would invest in Apple.
But the dependence on the iPhone is a lump risk. And the antitrust proceedings?
Exactly. iPhone dependency and global regulatory pressure are the biggest risks. But the premium pricing strategy in price-sensitive emerging markets could also prove problematic for Apple during an economic downturn. To address this, Apple is working intensively on new technologies such as augmented virtual reality, artificial intelligence, digital health services, and autonomous vehicle technology, which have significant long-term growth opportunities. That's what makes seasonal timing exciting.
What do the last 14 years look like?
Hit rate 78.57%, 11 positive, 3 negative years.
I bet the profits were explosive.
Plus 13% on average, a record year plus 49%, but also a loss of 11%.
Fast 50%, that's excitement.
Volatility, 14.86%. Drawdown, 11%. More action, more risk.
And the risk indicators?
Good but not perfect. Sharp 0.88, Calma 1.19. Decent but bought with fluctuations.
Now comes your trump card, the stock with the almost perfect balance sheet.
The super brain of the tech world, Alphabet Inc., seasonality from June 30th to July 29th. Here, one is only invested for 4 weeks.
Risks, advertising, regulation, AI competition.
Exactly. AI stocks have generally skyrocketed in recent years. However, Alphabet has been weak in recent weeks. This is certainly due to its heavy dependence on advertising revenue, lack of diversification in profitability, data privacy concerns, and image problems. However, one must also consider the opportunities such as growth in the cloud market, monetization of AI, and monetization of YouTube. For this, Alphabet is seasonally incredibly strong.
What does the balance sheet of the last 14 years look like?
13 positive, 1 mini loss. Cut, plus 8.7%. Best value, plus 22%. Worst, 0.7%.
That's crazy. And the risks?
Brilliant. Sharp 1.21, Calmar 1239. It doesn't get much better.
Really great numbers. Then the current correction at Google might not be so bad for seasonal reasons. I'm curious.
So that was the ultimate analysis. 3 top companies, 3 exciting seasonal patterns. As discussed, these stocks will move directly into our model portfolio with their seasonal purchase date. And afterwards, we will show you our seasonal portfolio running since 2024, which is provided at the end of each seasonal podcast episode as an update.
That is the decisive added value. We don't just do individual analyses, but show in the depot how everything develops together. So you will become your own little portfolio manager. That builds trust. But, Axel, why a sample portfolio and not a real money depot? Are you a scaredy cat?
Of course, you end up coming at me with the club again. You know conservation also applies to me. But to the question. The answer is in the introductory video. In short, it's due to our special approach with the stock market cycle, which is crucial for content and practice.
Thank you, Axel, for the clarifying words. I think I will put away the club for today. You're right. Even you deserve a little nature conservation.
Thank you, Lisa. I appreciate generous women. Your question was completely justified. And now we come to the seasonal stock portfolio. Stay tuned. So, here we are again with part 2. After dissecting the top 3 stocks for the summer, now it's time to get serious. We will look at what our seasonal pattern portfolio has actually achieved since its inception in early 2024.
Now I'm curious, Axel. The performance looked fantastic for over a year, but now in the last few weeks, has the tide turned or? Show me the chart.
You are directly addressing it, Lisa. Let's take a look at this. Here we see the development. Red, that's us. Blue, the MSCI World, as our benchmark.
Okay, that's really interesting. You have outperformed the MSCI World for over a year, successfully handled the setback last autumn, and only about 6 weeks ago, the index caught up with you again. Currently, it is ahead with 28% compared to your 22%. But how do you assess this strategically?
That is the crucial point. I see the MSCI World as a strategic core investment, the heart of any long-term portfolio. Our seasonal portfolio is more of a satellite, a supplement that can provide good diversification, and from the perspective of return and risk.
Okay, core satellite approach. That means you don't want to replace the MSCI world, but complement it. Then let's talk about the second part of your statement, the risk.
Exactly. Let's look at this chart. On the vertical axis, the return, and on the horizontal axis, the fluctuation, that is, the volatility.
Wow, okay, that's a strong argument. Only half as much thrill on the ride. But how does this stability come about? You don't intentionally exit the market during crashes, do you?
No, absolutely not. That is a misconception. We do not engage in active market timing. Stability is a potential positive side effect of the systematic approach. Due to the seasonality of individual stocks, there is a completely natural rotation in the portfolio. Trades end, new ones start later. As a result, the chance is greater that we are in phases of high liquidity when the market unexpectedly experiences a downturn.
Pure coincidence as well, but it is built into the system. Show me that in practice.
You see the black total line and the blue cash line, which rises sharply in Q3 2024.
Acronym. That is a very strong passage, Axel. And I see your portfolio has grown from 100,000 to over 122,000 euros. Are you investing more now?
No, and that is the second important strategic adjustment we have made. Since March/April, we have only been investing the original starting capital of 100,000 euros. The profit of over 22,000 euros remains as a cash buffer on the sidelines, maybe short term. But we are at the end of a very long, very strong stock market cycle. When the big bang comes, I want to have a buffer to absorb the initial blows. That is risk management. Those who have been involved since early 24 can act this way. Those who are just starting now do not have this buffer. And that's exactly why a model portfolio makes sense. To get to know the strategy first, in order to recognize its strengths and weaknesses. Learning comes before haste in the stock market.
Absolutely. Before we get to the individual stocks that brought the results, give us a complete cash check. What does the portfolio accounting look like with all the bells and whistles?
Very gladly. This here is the dashboard, our cockpit. On the left, we see again the performance, which shows the long outperformance in 2024 and the recent comeback of the MSCI.
And now the billing on the right. I find that exciting. Great that you are including the fees of minus 2,700 euros.
Absolutely. Honesty first. And then here is the breakdown. The stocks we currently hold are a total of 2,264 euros in the red. But, and this is crucial, we have already realized profits of over 27,000 euros.
Fantastic breakdown. Now, of course, we want to know, where did these realized gains come from? Show us the champions and the troublemakers.
Gladly. Here are the top winners. The leader is Burberry with a 73% increase in just 4 months. CMC Markets and Lang & Schwartz were also absolute rockets. Seasonality works best with stocks that have previously corrected sharply. Burberry had previously lost a lot. In contrast, stocks that had already performed very strongly before their upcoming seasonality then disappointed within the seasonality. At least that's my current impression. That's why it is so important to review approaches beforehand.
Let's move on to the losers. Alibaba is at the top with 21%.
Yes, it hurts. But look closely. The losses are partly double-digit, but none of the big losers have halved. 20% is painful, but within limits. The winners have brought significantly more than the losers have cost.
Understood. So, what is currently in the depot? And what happens with the new stocks today? ResMed, Apple, and Alphabet.
And that's exactly what I will do. I will sell the 3 weakest positions and replace them with our today's candidates.
Wait a moment, that's not strictly according to the system, is it? Shouldn't you wait until their seasonal time simply expires?
Theoretically, yes, if it were a purely quantitative system. But here, we have a universe of 80 to 90 values to choose from. It is a dynamic process. When I see that some values are not performing at all, while I receive high-quality new signals, I adjust accordingly. That is the active component. You will become your own little portfolio manager.
Okay, that makes sense. So, a clear strategy that allows room for adjustments. Very exciting, Axel. What is your conclusion for the viewers? Join now?
A very clear no. As convinced as I am of the approach, now is an extremely unfavorable time for a new entry. As I said, we are at the end of a huge bull market. The risk-reward ratio is poor.
Also, folks, you heard it. Patience is a virtue, especially in the stock market. We'll keep you updated.
That's exactly right. The next update will come as soon as there are new seasonal candidates again in August, because July is completely dead. Until then, thank you very much for watching.
Thank you. Take care.